Good day, students. I will be doing this exercise on the topic of shares, where I will be dealing with the buyback of shares, the redemption of preferences, the issues of shares, the declaration of dividends, and the accounting of the premium. Then after, I will summarize all of that into recording all that information into the general entries. Then after, further record that in the statement of changes in equity, and that is how far I will go with this question. I will be selective and I will purposely select certain questions, only the questions that relate to the preferences, the ordinary shares, the redemption, and the buyback, only in this question. So now it means the topic of taxation, I will not touch base on that. However, I might do a video later on specifically on the topic of taxation. It reads as follows. Hope Limited is a company that is involved in the manufacturing and retail of high-end African garments, sourcing the finest fabrics from all over Africa. Hope Limited's financial year end is 31st of December each and every year. The following is an extract of the company's trial balance at 31st of December 2015. So now we are given this extract, and is at the end of the accounting period, which is 31st of December, which in this case is the year 2015. Then now they further tell us that they further say in the trial balance, and the trial balance is for the ordinary stated capital, and after we are given 8% redeemable preference stated capital, retained earnings, and revaluation surplus. And with regard to ordinary stated capital, we have 1,200,000 shares that were already issued, and those shares, they amounted to 1,810,000 ordinary stated capital. Then we have 8% redeemable preferences, and this 8%, when it comes to preference, there will always be a percentage. It could be 12%, 8%, 10%, and it normally ranges around those percentages. This percentage is in other words, is the interest that the preference holders will be entitled at the end of the specific period, or in simple terms, at the end of the accounting period. That means out of the amount the preference shareholders have invested, they will get 8% from that. If it was money invested in a bank, this would be called interest on the investment. However, because the preference shareholders bought shares, therefore now this will be the 8% as dividends. However, as simple as the interest on the amount that someone has invested in any given bank. So now the capital that was invested in terms of preference capital, it was 1 million, meaning now at the end of each and every year, the preference shareholders will be entitled to 8% of the million rand of the capital that they have invested. And if we say 8% times by 1 million rand, it will give us an amount of the preference dividends for the full year that the preference shareholders will be entitled to. Then if we multiply that by 8%, it will be 1 million times by 8 divided by 100, so that we can see how much. So now in this case, it means our preference dividends for the full year will be 80,000 rands. For the full year, take note of that. For the full year, it will be 80,000 rands. Therefore, now that will be the preference dividends for a given full year. Retained earnings is given, and the revaluation surplus is given as 30,000 rands. So now we'll take note of that when we do the statement of changes in equity. Then below it says additional information. That means information that needs to be taken into account. Then it says under 1.1, and remember this is for ordinary stated capital. That means all the entries that relate to the ordinary stated capital are recorded under number 1. Then after it says under 1.1 that Hope Limited was incorporated in the year 2008 with an authorized ordinary share capital of 9 million. That means this company was authorized to issue 9 million shares of no par value. That means they are limited to issue shares but not above or not to exceed 9 million shares. And it further says that the shares reflected in the trial balance were issued at different prices, and we have seen that the company has already issued 1,200,000 ordinary shares. These shares are the shares that are already issued. So now if these shares are already issued, that means obviously they were taken out of the ones that were authorized, which is 9 million. The one which is a limit, meaning authorized shares are the share that the company can issue up to. That means the company can issue up to 9 million shares, but they are not allowed to exceed the 9 million shares. So now we know that 1.2 million were shares that were already issued, and these shares were issued at different prices. That means we don't know the exact price of these shares in total, meaning when you want to know the price for these shares, we'll have to calculate what is called the average issue price. Then we'll do that later on as the question instructs us to do so. Then after we have 1.2.1, it says on the 27th of March 2015, the company offered to issue one ordinary share for every 4 shares held to existing shareholders at 3 rand. So now at the 27th of March, the company issued shares, and they said they issue 1 share for how many? For every 4 shares. And when they say for every 4 shares, it means you divide by 4. Please take note of that. For every 4 shares, you always divide by that. And these shares were issued at the price of 3 rand. And they further say to us that the current market price was 3 rand 50 cents. And the minute the current market price is higher than the issue price, that is called the right issue, where the shares are issued at a price lower than the market price and to existing shareholders, the shareholders that are already in the share register. So now that means this is the so-called right issue, shares issued at a price lower than the market price. This is the right issue. So now let us just calculate how many shares will be issued as the right issue. First, we need to ask ourselves how many shares are already issued in terms of ordinary. Remember, right issue is only with regard to ordinary shares, not preference. And beside under number 1, we are dealing with the ordinary stated capital. So now the right issue, it has to do with the ordinary stated capital, not preference, because number 1 is dealing with the ordinary stated capital. That means we are dealing with the ordinary capital and the issue of the ordinary shares. So now we know that we had 1,200,000 shares that were already issued. So now we need to know how many 4 shares do we have in that 1,200,000. Then after, hence we have to say divide by 4. Then after we divide by 4, we multiply it by 1. Then that will give us the number of shares that would have been issued as the right issue shares. So now let me just show you the workings of the right issue. So now the right issue shares will be the total shares that have been issued, which is 1,200,000 shares, times by 1 divided by 4, and this will give us an amount of 300,000 if I'm not mistaken. So that will be 1,200,000 times by 1 divided by 4. That will give us 300,000 shares that will be issued as the right issue shares. So now 300,000 shares are the shares that will be issued as right issue shares. Therefore, now we have to say the number of shares that will be issued times by the price, because they will be issued at 3 rand instead of 3 rand 50 cents, which is the market price. So now we say times by 300,000 shares. This will give us 900,000 rands. This is 900,000 rands, which is the ordinary stated capital. That means our ordinary stated capital will have to be increased by 900,000 rands, which is the right issue shares that were issued to the existing shareholders at a price lower than the market price, which is 3 rand instead of 3 rand 50 cents. And we call that the right issue. Then now let us continue on that same note, and it says in the last sentence under 1.2.1 that all existing shareholders took up their right, and these shares were issued on the 30th of March. So now these are the shares that were issued to the existing shareholders, and they are telling us that all the shareholders, they took up their right. That means they bought these shares at the price lower than the market price, being 3 rand instead of 3 rand 50. Then now under 1.2.2 it says that on the 30th of March 2015, 10,000 rands was issued to the paid to the financial institution that had arranged the issue of the shares on behalf of the company. This is therefore a share issue cost. We know that under 1.2.1 that there was a right issue. And now after this right issue, they say now this 10,000 was incurred and paid to the financial institution. So now if this was paid, then now they further say that this is therefore the share issue cost. That means the expense that was incurred to issue these shares and was paid to this financial institution company, then now it was paid, then this will be share issue cost or share issue expense. In simple terms, if you remember that, you can call it share issue cost or share issue expense, the cost that we incur to issue these right issue shares to the public, in fact to the existing shareholders, sorry. Then we will account for that when we are required in the journal entries or in the statement of changes in equity, because we know that share issue cost is written, it will be recorded under the ordinary stated capital. It will be reducing our ordinary stated capital because it is an expense that is related to the issue of ordinary stated capital or ordinary shares. So now that is why the 10,000 will be recorded under the ordinary stated capital when we are doing the statement of changes in equity. Then now under 1.3 it says, in an effort to increase its share price, Hope Limited decide on the 31st of March 2015, so 31st of October 2015, on a share buyback. Remember, share buyback is the same as the redemption. Buyback is when you redeem something. That means you're buying something back or you are redeeming it. And always redemption is at a higher price. Whenever there's a redemption is at a price higher than the price that was an initial price, which is the issue price. So now in this case, these shares were redeemed, and they say there was a share buyback of 100,000 shares of the issue share at 3 rand 50 each. So now in this case, there is a redemption or there is a buyback, and we are given the buyback price as 3 rand 50 cents. We are not given the issue price. We are not given the premium. In fact, we are given the buyback price. It means we need to know the issue price, and we compare the issue price with the redemption price or the buyback price, because the buyback price is 3 rand 50. Then we have to compare the issue price, which is the price at which the shares were issued at, and we compare that with the buyback price. Then the difference between the two will be the so-called premium. In this case, we don't know how much is the average price, but they are telling us that the accountant must still account the average historic share issue price. Why are they saying this? Is because there was a sentence that told us that all the shares that are reflected on the trial balance were issued at different prices. So now the minute shares are issued at different prices, when there is a buyback, we need to determine what is called the average price of the shares, which is the average price of the 1,200,000 shares, inclusive of the 300,000 shares that were issued as the right issue. We need not to forget that there was another issue during the current year, and that issue, remember, it was on the 27th of March where there was a right issue. And now the buyback is taking place at the end of the month of October. That means when October came, these shares, which is the 300,000 shares that were issued as the right issue, they would have been recorded already in the business. So now that is another thing that we need to take into account. So now we are told that there was a buyback of 100,000. Only 100,000 shares were bought back. Please take note of that. Only 100,000 shares were bought back. So now we'll have to account for that 100,000. Then we have to calculate average price in the future when the question requires us to do so. Then after, it says now under 1.4 that on the 31st of December, which is the end of the current year accounting period, a further issue of 180,000 shares was issued at a price of R4 per share by means of a public offering, and they say refer to additional information 2.3. That means this 180,000 shares that were issued, it was because of an entry that is under 2.3, but we'll see that later on as we read throughout this question. So now it means there was 180,000 shares that are issued at R4, and if we calculate that, we'll say 180,000 shares times by 4, that will give us 720,000 ordinary stated capital that will be increased by. So now this will give us 720 stated capital as the amount that will be received from this public offering of the shares. Then now 1.5 says to us that no interim ordinary dividends were declared during the year 2015. However, a final dividend was proposed at an AGM on the 30th of November 2015. And now, however, the proposal was rejected. So now, though there was a declaration at the end of the year, the proposal was rejected, perhaps because of other financial reasons. Therefore, now we go to number 2. That was number 1, and number 1 was mainly focusing on the ordinary stated capital. And number 2 is focusing on the preference stated capital. Please take note of that. Is focusing on the preference stated capital. So now I have analyzed all the ordinary, therefore now I'll be analyzing the preference stated capital entries. Under the preference stated capital entries, 2.1 says to us that the company has authorized to issue 500,000 preference shares of no par value. That means the company is limited to issue, in other words, is limited. Authorized means the limit of the number of shares is limited to issue up to 500,000 preference shares of no par value. And they further say 200,000 preference shares had, take note of that, the past tense, had been issued during 2010 at an issue price of R5. So now that means the 200,000 shares out of the 500,000 shares that was a limit were already issued. So now 200,000 was already issued, and if 200,000 was issued, therefore now how much would have been the capital? That means they were issued at R5, therefore it will be 200,000 times by 5. It means the preference stated capital by now is supposed to be R1 million, because if we say 200,000 times by 5, this gives us R1 million, 1 million rands. Let us check in our trial balance if do we have a 1 million rand showing that preference shares were issued to a total of 1 million rands. Here is our 8% redeemable preference stated capital. It is honestly R1 million. That means the R1 million that we see here was the issue of 200,000 shares, if I can write it here, times by the price of R5, and that gave us R1 million. So now that's where the R1 million is coming from the 200,000 shares that were issued at the price of R5 per share. Then after, they further say to us that one of the conditions at the issue of the preference shares was that the preference shares will be redeemed at the option of Hope Limited. The reason why this is always very critical to be emphasized is because whenever the shares are redeemed at the option of the company, then those shares will be recorded as equity. However, if the shares are redeemed at the option of the shareholder, therefore now they become a liability. However, because the redemption is at the option of the company, or when the company decides to do so, therefore now it will be recorded as equity. That is why preference stated capital will be recorded under your equity and will also appear in the statement of changes in equity. Therefore, now we have highlighted that, and let us move a little bit further now under 2.2. 2.2 says to us that during June 2015, take note of the date and the time frame. The date becomes very crucial and very critical when it comes to the topic of preference shares. In fact, in accounting, dates become very important because everything can be messed up because of the dates. It says during June 2015, remember the accounting period ends in December. So now this is 6 months before the end of the accounting period. During June 2015, the board of directors passed a resolution to declare preference dividends, and they were declared when? In June. And they say the full amount due to the preference shareholder was paid on the 30th of June 2015 out of the available cash resources. So now after they declared the preference dividends in June, and by the 30th of June, these preference dividends were paid out. And let me just emphasize something that is very crucial with regard to preference dividends. Now, preference dividends, it will always be stated that 8% redeemable preference dividends or 10% or whatever percentage they might give it to you. In this case, we are given 8%. That means the preference shareholders are entitled to 8% of the capital that they have invested, and that 8% is called dividends. And in this case, we know that the preference shareholders have invested $1 million. That means 8% of that million. Remember, 8% is for the full year. That 8% is 8% per annum. Let me also underline that. 8% is 8% per annum. P.A. P.A. That is per annum. This is 8% is the interest in simple terms for the full year. So now meaning preference shareholders are entitled to 8% of what they have invested. And if you say $1 million times by 8%, I think that gave us 80,000 rands, if I still remember my calculations. Times by 8 divided by 100. This will give us 80,000. 80,000 is the preference dividends for the full year. Is the preference dividends for the full year. It is the preference dividends for the full year. So now that will be 80,000. However, we only need preference dividends to be accounted for 6 months out of the 12 months. Why must it be 6 months out of the 12 months? Because these shares were declared and they were paid in the middle of June. And by 30th of June, they were paid. It says there, 30th of June, they were paid. So now it means these shareholders will only be entitled to dividends only for half of the year. We can't give them the full 80,000 because 80,000 is for the full year, but we only have to give them dividends only for the 6 months, which is the period in which dividends were declared and paid to them. So now that is why now we have to say out of the 80,000, we multiply that by 6, we divide that by 12, then it will give us total of 40,000 as the preference dividends only for 6 months, which is half of the year. So now this is the amount of the preference dividends that will be recorded in the statement of changes in equity, and if there are general interest required, then that will have to be recorded. So now it will be 40,000, which is the preference dividends only for 6 months, which is part of the year up to June, not for the full year, which is 80,000 rands. Please take note of that. Dates becomes very critical when it comes to dividends. So now that means our preference dividends that are paid at the end of June, it is an amount of 40,000 rands. It's only for the 6 months, which is January, February, March, April, May, June, only 6 months up to June 2015. Then after it says under 2.3 that during June 2015, take note of the date again, is during June 2015, the board of directors passed a resolution to redeem all, not some. This sometimes used to be bold. All is not some, all of them. So now they redeem all the preference dividends. Let me just highlight that in, circle that in red. They say all of them, not some. So now they decided to redeem all the preference dividends. And we need to ask ourselves, how many preference dividends do we have first? We have preference dividends that amount up to a total of 200,000. We have 200,000 under 1.1. There is 200,000. There I'm circling. So now when they are saying all, they are referring to the 200,000 preference dividends that were issued, because these are the only preference shares, these are the only preference shares that were issued. So now they are referring to these preference shares that were issued. So now when they say all, that means all the 200,000 shares were redeemed. That means we have to give them back to the preference shareholder. And they say now they were redeemed, all of them, at the premium of 10 rand per share. Take note, they say per share, meaning now we have to calculate the so-called premium. We have to calculate a premium, and the premium is per share. Whenever your premium is in rands, you calculate it from the number of shares. However, if the premium is a percentage, you calculate it from the capital that is being redeemed. In this case, we have 200,000 shares. 200,000 shares. We multiply this by 10 cents. And if we multiply this by 10 cents, it will give us 20,000 rands. This will be the premium on redemption. Premium on redemption. And now let us just confirm that in our calculations we have 200,000 shares. Multiply that by 10 cents, it will give us 20,000 rands. This is the amount that will be given to the preference shareholder. However, I want to highlight something that is very crucial and very important when it comes to this area. When the redemption takes place, we are given the premium on redemption as 10 rand per share. However, sometimes you can be given the redemption price. And when you are given the redemption price, then we have to compare the issue price with the redemption price, and the difference between the two will be a premium. In this case, we have the issue price. The issue price was 5 rand. This is the price at which the preference shares were issued at. And we don't know the redemption price. But we know that the difference between the issue price, which is 5 rand, and the redemption price that we don't know, the difference between the two was 10 rand. And the redemption price was higher than the issue price by 10 cents. So now it means how they calculated this. They said issue price. They said issue price 5 rand. Then after they said redemption price. They said the redemption price is 5 rand 10 cents. Where do I get 10 cents? It's because the minute a premium is 10 cents, it means the redemption price was higher from the issue price by 10 cents. So now it means the redemption price was 5 rand 10 cents. Then after they said 5 rand, which is the issue price, less 5 rand 10 cents, they got 10 cents, which is the premium on redemption. This 10 cents is the premium that you see here, the premium on redemption. So in other words, this means that sometimes you might not be given the premium on redemption. You might be given the redemption price. That means if they would have given you not the premium, or if they could have said at a price, they could have said at a price of 5 rand 10 cents. So now they could have given you 5 rand 10 cents. And if you were given the price of 5 rand 10 cents, then you'll have to say the issue price of 5 rand less the redemption price. Then that will give us the premium of 10 cents. Then you use that 10 cents, you multiply that 10 cents from the number of shares that are being redeemed. Then you get 20,000 as the premium on the redemption of preference shares. This is very crucial, guys. I'm emphasizing this because you can be asked such question to test your intellectual or your critical thinking or your understanding of the topic of preferences. These are some crucial aspects. So now we know that is 10 cents times by 200,000 shares, and this will give us 20,000 rands as the premium on the redemption of preferences. Then after, they further say to us that according to the resolution, remember this is the resolution we're talking about, the one that was passed. The director has passed a resolution. So now they say according to this resolution, the redemption will take place on the 30th of June 2015. That means these shares will be redeemed completely on the 30th of June 2015 and be removed from the books of the business. Then after, they say now the redemption excluding preference dividends, take note of that. That means in the redemption we must not include the preference dividends. why must we not include preference dividends? It's because they told us that the full amount due to the preference shareholder was paid on the 30th of June out of the available cash resources. It means there is money available. So now the preference dividends that were declared under 2.2, there was money available, we paid that, and it was completely done. That means now we don't need to take into account the preference dividends in this case. Hence they say the redemption excluding the preference dividends will be financed as follows. In other words, they are telling us that they don't have money to pay to the preference shareholder. How much are they owing the preference shareholder? Remember, they said all the preference dividends were redeemed. That means the 1 million, which is the capital, will have to be paid back, plus the 20,000. This is 20,000, the premium. That means now the company will have to pay 1,020,000 rands. If we add the two, it should give us 1,020,000. 20,000 the premium plus 1 million. That will be 1,020,000 rands. That means now the company has to pay the preference shareholder 1,020,000 rands. This is what the company owes to the preference shareholder. However, there is no money available. So now they say there's no money available. Then now we have to raise funds. We have to raise money to pay this 1 million to the preference shareholder, because we have to give the capital plus the top-up amount, which is 20,000, so-called a premium. So now they say we must issue 180,000 rands at an issue price of 4 rands in order to finance that. So now let us check. If we issue 180,000 shares, how much will be the money raised from that? We have to multiply that by 4. That means it will be the total of 720,000 shares that must be issued. These shares must be issued in order to finance the 1,020,000. But still, 1,020,000 will not be enough from this 720,000 rands, or 720,000 rands will not be enough to pay the 1,020,000 rands. That is why now they say the remaining balance will be financed from a loan from Style Bank. That means the rest of the balance, which is 1 million less 1,020,000 less 720,000, the difference, which is the balance of 20,000, will have to be money borrowed from the bank. That means the 300,000, which is the balance, must be borrowed from the bank in the form of a loan. That is the remaining balance that they are referring to. Because we owed this amount to the preference shareholder, and we raised money through the public offering of the shares, then the remainder we still had to raise 300,000, and they are telling us that 300,000 must be money borrowed from the bank, which is Style Bank. So now we have all the funds have been raised from this point of view now. So now let us continue again, and we go to 2.4. This further says that it was minuted during the recent meeting on the board of directors that solvency and liquidity had been considered, and that board is satisfied that neither will be affected by a distribution to the shareholders. That means now when they are redeeming these preference shares, they first have to do the solvency, the company solvency, and the liquidity test, where they are doing the ratio analysis, and they've realized that no, the company is very solvent, their liabilities are less than their assets, or their assets are less than their liabilities. Therefore now they can pay back this amount to the preference shareholder. That will not affect the distribution, that will not affect the company. So now they're just emphasizing that everything can go as it's supposed to go. So now, as I said, that I will be continuing to 2.5 again. 2.5 says all, not some, all the transactions decided upon by the directors at their meeting during June 2005 took place as foreseen. So now everything that took place in the year 2005 by June, which is during June, the redemption and the declaration of preference dividends, it took place as the directors planned to do so. So now they say on the 30th of June 2015, the following transactions occurred. 2.1.5. the preference dividends were declared and paid. So now the preference dividend that were declared, they are telling us that they were also paid. Where are these preference dividends? That was under number 2.2, where preference dividends were declared and they are telling us that they were also paid. Remember, we said preference dividends will be an amount of 40,000 rands. Why? Because it's only for 6 months. I think we did show those calculations. Okay, not here, but we show that we only need them for 6 months because they were declared and they were paid in the middle of June. Then after now, they are further saying to us under 2.5.2 that the amounts owed for capital and premium at redemption of preference shares were recorded. Remember now, when we redeemed the preference shares, there were two things that had to be paid to the preference shareholder, and those two things was the capital and the premium. And we said the premium will be 20,000 rands, and we said the capital will be $1 million because all the capital or all the shares were redeemed back to the preference shareholder. So now that means it was a total amount of 1,020,000, meaning the premium and the capital. So now they are telling us that the amounts owed in terms of the capital and the premium at the redemption of the preference shares were recorded. That means we have to record the liability. In this case, we have to raise the liability. Raise a liability when they say they were recorded. Raise a liability when we do journal interest. You don't have to write this. I'm just highlighting how you must take notes of small things. Then it says all the ordinary shares offered to the public were issued. Remember, there was a public offering, and that public offering was under number 2.3, where we issued 180,000 shares, and these shares were of a public offering, and that was referenced under the ordinary part, where they said under 1.4 that 180,000 shares. So it means these shares are the ones that were issued in order to finance or in order to raise money to pay for the redemption of preference dividends. And they say it was 4 rand per share by means of public offering. That means now this was recorded, everything was done in a perfect way. So now we also have to record that if we are required in the future. Then after 2.5.2 say that the loan from Style Bank was acquired. Remember, after we issued the 180,000 shares, which was 180,000 shares that amounted to 720,000 rands, there was still a balance remaining, and that balance remaining was 300,000. And they instructed that we must take loan from Style Bank, and they are telling us now the loan that we took from Stylish Bank was correctly recorded. So now we did get the loan. That means the loan was approved by Style Bank. 2.5.5 says the amount owed to preference shareholders was paid, which is the capital and the premium. Remember now, we had an amount that we owed to the preference shareholder, and the amount that we owed was 1,020,000. And since there was no cash available in the bank, we raised funds through the issue of shares that amounted to 720,000 rands. Then there was still a balance left. Then we raised that balance through the borrowing of the loan from Style Bank. Then there was money available. Now when money was raised and it was available in our bank account, therefore now a payment took place as it was supposed to be, and we paid the capital and the premium that was due. The capital of 1 million and the premium of 20,000, which was due to the preference shareholder. So now that is what they are telling us under 2.5. Now under number 3, it says that the statement of comprehensive income for the year ended 31st December 2015 showed a total comprehensive income. Take note, it's a total comprehensive income, meaning the revaluation surplus has already been accounted for. They say included in this amount was an increase in the revaluation surplus of a property of 40,000. So now they are confirming that already. That means now 40,000 is the revaluation surplus, and this amount must be extracted and recorded under the revaluation surplus under the statement of changes in equity. We'll take that into account when we do the statement of changes in equity. The taxation matters, I will not do this because I want only to focus on the statement of changes in equity and the issues of shares. So now I will also don't do the further part, and I will not do the further part. I will do this later on. So now we go straight to the requirements and we check what then is required of us in this exercise. We are required under 1.1 to prepare general entries of Hope Limited to record the following transactions. The right issue as described in paragraph 1.2.1. There was a right issue, and the right issue amounted to 900,000 rands, remember, where we issued 300,000 shares to existing shareholders at an issue price of 3 rand, and we multiplied those shares by 3, and that gave us 300,000 rands. And let me just go and reference so that you are mindful of what we are exactly doing, although I've already done all the calculations for you. Remember, the right issue took place in 1.2.1 on the 27th of March, where we issued 1 share for every 4 shares held to existing shareholders at an issue price of 3 rand. Therefore, now we went back and said, how many shares do we have? Or how many shares are these shareholders have? And we said, this shareholder, they have 1,200,000 shares. Then we have to divide by 4 because we need to know how many 4 shares do they have. Then we divided this by 4. Then after we multiplied that by 1, and it gave us 300,000 shares that will be issued at the right issue. And we multiply this by the issue price of 3 rand. Then this gave us 900,000 rands as the right issue shares. So now we have to do a journal entry for that, as we are required to do so. So now this is 1.1 that we are doing now. This is 1.1, and under 1.1 we have to debit our bank, and we debit our bank because the shares were issued to the existing shareholders. These shareholders, they did pay us money, but it was just lower than the market price. At the end of the day, we did receive money from our bank account. It's only capitalization where shares are issued for free that bank account will not be affected, but retained earnings will be debited if it's a capitalization issue where shares are issued for free. So now this will be 900,000 rands. Then we have to credit our ordinary stated capital. Ordinary stated capital, and our ordinary stated capital will be an amount of 900,000 rands. Nothing will change. That will be 900,000 rands. So now we have recorded the first part of 1.1, which was just to record the right issue. Now our second requirement is that we have to prepare, or we have to do the buyback of ordinary shares as described. Remember, we are preparing general journal entries. So now we have to record or prepare the buyback of ordinary shares as described in paragraph 1.3. And they say no narrations are required. It's not necessary for you to narrate and explain what the journal entry was recorded for or is all about. So now we have to go and check our buyback. There was a buyback of ordinary shares, or there was a redemption, because buyback is when you buy, when you redeem something. Redemption is buying back something that previously used to be yours. So now there was a buyback under 1.3, and the buyback under 1.3, here is the buyback under 1.3. They said in an effort to increase its share price, Hope Limited decided on the 31st of October in the year 2015 on a share buyback of 100,000 shares of the issue price of at 3 rand 50 each. Of the issued price at 3 rand 50 each, and they say the accountant must still calculate the average historic share price. So now in this place we need to take into cognizance of the time frame, because we have the right issue that took place on the 27th of March. This is the right issue 27th of March in the same year. And when now we have the buyback is at the end of October. And it means when the buyback took place we have to record first the shares that were here, the shares that were issued during the year, because these shares would have been already in the share register now. So now if they are already in the share register, therefore now this is the end of October, and there are shares issued in October on March, and we're in October. It means we first have to add the 300,000 shares that were issued as the right issue, 300,000 shares that were issued as the right issue, because these shares would have been included by the end of October when the buyback takes place. So now it means when we calculate the average price, we have to take into account the shares that were issued as the right issue shares to the existing shareholders. So now please be mindful of the fact that whenever there is a buyback or whenever there is a redemption, there is always the premium. Don't forget that. Where there is a buyback or where there is a redemption, there will always be a premium. So now we need to know how much is the premium. And how do we calculate the premium? We need to know the issue price and the redemption price, and we compare the issue price with the redemption price, and the difference between the two will be the premium. In this case, we don't know the issue price, but we know the redemption price. And we know again that the shares that are reflected on the share register were issued at different prices. It means we don't know the exact price of the shares that we see in the share register, the one that are in the trial balance. We don't know the exact one amount or price of these shares. So now, in other words, we have to take this number of shares and add the 300,000 shares that were issued as the right issue, which is 300,000 shares issued as the right issue. Then this will give us 1,500,000 shares. Then after we say 1,500,000 shares, we divide that by, we take the total cost, total capital, which is 1,810,000. We also add the 900,000 rands, because we know that our right issue capital was 900,000 rands. So in other words, we say we add all the capital, then we divide by the number of shares to get to the average share issue price. We get to the average share issue price. Then after, we'll know how much was the average share issue price. That is why they emphasize that the accountant must still calculate the average historic share issue price. So now let me calculate that average share issue price with you so that we know how to calculate it. Then after, we record the entry for this transaction. So now we are calculating average share issue price. Average share issue price. And our average share issue price will be equal to total ordinary stated capital, total ordinary stated capital, and our total ordinary stated capital will be an amount. Then we divide that by total ordinary shares. Total ordinary shares. Our total stated capital will be 1,810,000 plus the capital of the right issue shares, which was 900,000, and we divide this by the number of shares now, which was 1,200,000, plus the 300,000 shares that were issued as the right issue. That means this will give us an amount of 1,810,000 plus 900,000, and this will be 2,710,000. Then after, we say 1,200,000 plus 300,000 rands. This will give us 1,500,000 rands. These are the number of shares. I'm writing rands because I want to make it clear that this is rands and this is in shares. Then after, we say the total capital, as I said, 2,710,000 divide by 1,500,000. This will give us 1 rand 81 cents. 1 rand 81 cents. That will be 1 rand 81 cents per share. This is the average issue price. This is average issue price per share. Average issue price per share. So now this was the average issue price, and we have the redemption price or the buyback price. Buyback price. Our buyback price is 3 rand 50 cents. So now we need to calculate the premium on redemption, or premium on buyback, or premium at buyback. At the point when we are buying back, premium at buyback of shares. Premium at buyback will be the average issue price, which is 1 rand 81 cents, less the buyback price, which is 3 rand 50 cents. Then now if we subtract those two, we'll get to the premium on the buyback. That means 1 rand 81 minus 3 rand 50 cents. This will give us an amount of 1 rand 69 cents, and this will be 1 rand 69, which is the premium at buyback of preference. So now this is the premium, which is premium per share, because it is in rands. Premium per share. So now from here we know the premium per share. Then the total premium now that we have to calculate, the premium at buyback, which is the total premium that I'm talking about. Total premium on buyback will be 1 rand 69 cents. Multiply this by the number of shares that were bought back, and it's only 100,000 shares that were bought back. 1 rand 69 times by 100,000. Let me just use the whole amount. 1 rand 69 times by 100,000. This will be 169,000. This will be 169,000 rands. So now this will be the premium at redemption of preferences. Take note of the fact that we first had to calculate the premium per share, and the premium per share was 1 rand 69. Why this is very important is because in this case we don't know the issue price. We first had to calculate the issue price, which was the average issue price, and we compare that with the buyback price or redemption price, and the difference between the two. And most of the times, guys, the buyback price will be higher than the issue price, and the difference will be the premium on the redemption, which is the premium per share. And you ask yourself, how many shares were bought back, or how many shares were redeemed? And in this case, we know that the shares that were bought back, it was 100,000 shares that were bought back. Here it was a share buyback of 100,000 shares. So now you take the premium, you multiply it by the number of shares that are being redeemed, and the minute you multiply that, then you'll get to the premium on the redemption of preference shares. So now we have calculated that, and we know that the premium is 169,000. Then we need to calculate now the capital that will be redeemed. We need to calculate the capital that will be redeemed, which is the ordinary stated capital. Ordinary stated capital, which is the capital that will be redeemed. Ordinary stated capital. Remember, the ordinary stated capital is based on the average price, and the average issue price is 1 rand 81 cents, because we calculated that the average price at which these shares were issued on average was 1 rand 69. 1 rand 81. Then we multiply that by the number of shares that are being redeemed or being bought back. Then this will give us the total of the capital that will be given back to the ordinary shareholder. 1 rand 81 cents, multiply this by 100,000 shares that are being redeemed or being bought back. This will give us 181,000 rands. So now this will be the shares that will be bought back, 181,000 rands. This is the capital. So now, in other words, if we can summarize and put this in a format, and you say how much to pay or how much to pay to the shareholder, the company will pay the capital, ordinary stated capital, ordinary stated capital. The company will pay the capital of 181,000 rands, and the company will pay the premium at redemption. Premium at buyback, not redemption. It's the same meaning, guys. Premium at buyback. And the premium at buyback is 169,000. So now, in simple terms, it means this company will have to pay a total of 350,000 rands. This will pay a total of 181 plus 169,000 rands. Therefore, now the company will have to pay 350,000 rands back to the preference shareholder, so to the ordinary shareholder. So now this is amount to be paid. Amount to be paid. This is the amount that will be paid to the ordinary shareholder. And we are required to record the general entry. And our general entry will be based on these two amounts, which the total will obviously be 350,000 rands. So now we have to debit ordinary stated capital, ordinary stated capital, debit ordinary stated capital, and we credit our premium at buyback, premium at buyback, and our ordinary stated capital is 181,000, and our premium at buyback is 169,000 rands. So now, then after we credit our shareholders, ordinary shareholders, because this is ordinary shareholders, ordinary shareholders, our ordinary shareholders will be the total of the debit side, which is 350,000 rands. So now this is what is due to the preference shareholders. It will be an entry where we raise the liability. And remember now we have recorded the ordinary stated capital on the debit side. And the reason why we do this is because we are cancelling what was initially recorded. And in the trial balance, if you still remember, in the trial balance we had our ordinary stated capital recorded on the credit side of the trial balance, on the credit side. This is equity. So now the minute we record in a journal entry ordinary stated capital on the debit side, we are cancelling this entry. We cancel this from being a capital, then now it becomes immediately a liability because it is about to be paid to the preference shareholder. So now even the amount of the 100,000 or the number of 100,000 ordinary shares that are being bought back, they were recorded on the credit side. So now the minute we record this on the debit side, we cancel the credit side. Therefore now that means the capital is being transferred into a liability account before it gets to be paid to the ordinary shareholder. Therefore now the premium will be debited because this is just an expense that we pay to the ordinary shareholder because of the buyback of these shares. So now that was 1.1 that we were required to record, and we have clearly recorded this very, very well. Then let us go to the next requirement and see what are we then required next to do. The next requirement is to calculate, just to calculate the amount that should be borrowed from Style Bank. And I think we have done that already. We know that it is 100,000 rands. How much must be borrowed from Style Bank? We know that it is 300,000. However, we need to show the calculations. So now this will be 1.2. And under 1.2, we first need to know how much to pay or how much to be paid. First of all, Let me just write this as a question. How much to be paid? Don't write this, please, when you write an exam. How much to be paid? The minute I know how much to be paid, then I will know how much to raise. Then I will know how much to raise as in the form of the loan. We know that this was because of the redemption of preference shares. This entry has to do with the redemption of preference shares, because this entry it refers us to 2.3. Let us go and check 2.3. What is 2.3 all about? 2.3, it was the redemption of the preference shares. It was the redemption of the preference shares. So now let us check this redemption. 2.3, they said to us there was a redemption. The board of directors passed a resolution to redeem all. That means to pay back the capital plus the premium. And we said how much the capital? The capital is R1,000,000. So now we said, okay, the capital is R1,000,000. Then we said R1,000,000, and we said plus 20,000, and that gave us 1,020,000. And remember, 20,000 was a premium. Where was that 20,000 coming from? We said 10 cents per share multiplied by the number of shares that were redeemed or being redeemed, which is 200,000, because all of them, which is the whole 200,000, is being redeemed. So now we said 200,000 times by 10 cents, and that gave us 20,000, which is the premium. And we took the capital, which is the preference share capital. The redeemable preference share capital of R1,000,000, because we are paying everything now back to this preference shareholder, meaning we owe 1,000,000 and we owe a premium of 20,000. So now let me just structure this in a formal way. So now we have to pay back preference stated capital, preference stated capital, preference stated capital, and our preference stated capital is R1,000,000. We also have to pay back a premium at redemption, and our premium at redemption is 20,000 rands. Remember, they also told us that there is no money available. We need to raise funds. They said we owe 1,020,000, but there is no money. They said the redemption excluding, that means do not include preference dividends, because they were already paid, there was money available. And they said will be financed as follows. That means we must raise money to pay what we owe to the preference shareholder because of the redemption. And they said we must first of all, this is number one, this is the last one, first of all issue 180,000 shares at R4 in order to pay the 1,020,000 that you owe because of the redemption of the preference shares. So now we know that amount to be raised, because we know that this need to be raised, or how much to be paid or how much to be raised. This is what we need. Either way you say how much to be paid or how much to be raised is still the same thing. How much to be paid or how much to be raised. So now we say amount to be raised. Amount to be raised, because we don't have money available. We have to raise this 1,020,000 for the payment of the redemption of preference shares, which is 20,000 plus 1,000,000, which is 1,020,000 rands. So now they said, first of all, rule number one, you must issue ordinary shares. Then we have to say ordinary stated capital, ordinary stated capital, or if you want you can say issue of ordinary shares. We said that we were required to issue 180,000 shares, remember, at R4. Then this gave us 720,000 rands. That means we'll get 720 from the issue of ordinary shares. So now let me just show that in calculations. It will be 180,000 multiply this by 4 rand, it will give us 720,000 rands. However, 720,000 is not enough, because if you say 720 less 1,020,000, there is still a balance to be raised. There is still 300,000 that we need to raise. So now we don't have enough money as per yet. So now it means there is still 300,000 rands that need to be raised. Therefore, now instruction number 2 will tell us how must this money be raised. Second instruction, which is number 2. There's number 2. How must this money be raised? The remainder. The remaining balance will be financed from Style Bank. So now this is the second part now. That means the amount to be raised or loan from Style Bank will be 300,000 rands, which is the remaining balance. Therefore, now this is the instruction number 2 in terms of how you must raise these funds. This will be loan from Style Bank. Loan from Style Bank. So now this is the loan for the balance to be raised from Style Bank. So now we know that the 3 marks was for the loan that must be raised from Style Bank, which is the second requirement that we were required to do. Then now we go to the next requirement, and the next requirement is instructing us to record, which is 1.3. 1.3, this is where we are. We are then required now to prepare the general entries of Hope Limited to record the transactions relating to transactions as described in 2.5.2, 2.5.3, 2.5.4, and 2.5.5. And they say narrations are not required. Worry not about narrations, they are not required. Remember, narration is when we explain what is the general entry all about. So now they say, don't be mindful, don't mind too much about the narrations. They are not much necessary. So now let us go and check 2.5.2, 2.5.3, 2.5.4, and 2.5.5. And these are the entries that they are referring to, that they say we must do. So now these entries are already recorded here under 2.5. So now we are doing 2.5.2, 2.5.3, 2.5.4, and 2.5.5. That is what we'll be doing. First of all, 2.5.2 says the amount owed for capital and premium at redemption of preference shares was recorded, not paid. They say was recorded. So now that is what we are recording. In fact, it's able to say must be recorded. So now we are recording the entry for the redemption of preference shares, not for the payment of preference shares. It means we are raising a liability here. Raising a liability. And when we raise a liability, that is very simple. You debit the capital, you debit the premium, and you credit preference stated capital. Nothing changes. So now that is requirement 1.3. 1.3, just a different color to be stylish. So now we do 1.3, and 1.3 we debit how much capital is redeemed, or how much capital has been redeemed, or how much capital is being redeemed. The preference stated capital that is being redeemed is the full million, because all the preference shares were redeemed. So now we debit our preference stated capital, debit preference stated capital, and when we debit our preference stated capital, it will be 1 million rand. 1, 2, 3, 4, 5, 6, 1 million. Remember, I said immediately when you debit your preference stated capital, you cancel the capital that was in the extracted trial balance, in the extract of the trial balance, because the preference stated capital was initially recorded as equity on the credit side when the preference shareholder bought the shares. And you can see 8% redeemable preference stated capital. It is 1 million and is recorded on the credit side of the trial balance. meaning now it was recorded or recognized at the beginning or at the commencement of the entry as equity on the credit side. So immediately now, the minute we're redeeming preference shares, we have to cancel the capital. And to cancel the capital is to record it on the debit side. That is why now preference or redeem preference stated capital is recorded on the debit side. We cancel the equity which was on the credit side in the trial balance. Then after we debit premium at redemption. Premium at redemption. This is more or less an expense. And we know that expenses increase on the debit side because this is the top-up amount that we pay above the capital. And any amount you pay above the capital will obviously be an expense. If it was in the case of the bank, this will be interest expense, but we just call it premium when it comes to shares. And the premium, we have seen that it is 20,000 rands. Then after now, we raise a liability. Then when we raise the liability, we credit our preference shareholders. Preference shareholders. And our preference shareholders will be 1,020,000 rands. 1,020,000 rands. So now we have recorded the liability or have recorded the redemption. This is what was required. We were just required to do this part. Then now we go to the second part of this entry, and the second part of this entry now will be the recording of the next part, which is 2.5.3. And 2.5.3 now, it says all the ordinary shares offered to the public were issued. There was a public offering. And the public offering was the one of the 180,000 shares offered to the public. And these shares, remember, they were issued at 4 rand, and they were issued in order to finance for the redemption of preference shares. I just want to link all of that because there was no money available to pay the 1,020,000 to the preference shareholder at the redemption of preference shares. Therefore, now there was an instruction or an order from the board of directors to issue 120,000 ordinary shares. Take note, ordinary shares at 4 rand to the public. That is why the 120,000 appears under preference entries, because this is preference number 2, and it also appears under ordinary because we issued ordinary shares in order to finance for the redemption of preference shares. And we know that 180,000 times by 4, it gave us an amount of 720,000 rands. We have calculated that already. So now we just have to record the journal entry with regards to that. So now our journal entry will be debit bank. This was 2.5.2. This is 2.5.3. We debit our bank account. And our bank account will be 720,000 rands. And we credit our ordinary stated capital. Our ordinary stated capital with 720,000 rands for the public offering, which was the issue because of the redemption of preference shares. Remember, the right issue was not for the public. It was only for the existing shareholders. The right issue was not for the public, only for the existing shareholders. Then now the next part is 2.5.4. They say the loan from Style Bank was acquired. So now we must record the entry for the loan. And we know that if you acquire a loan, then obviously your bank account will increase. So now this is 2.5.4. 2.5.4. Then if you acquire a loan from the bank, your bank account will increase because you would have received, or you will receive, the 300,000 rands into your bank account. Then after we credit our loan and our loan is from Style Bank. That is the loan from Style Bank. That will be the same amount of 300,000 rands. 300,000 rands would have been an amount. Then after we go to the last entry, and the last entry is the recording now, where they say we must, under 2.5, where they say the amount owed to preference shareholders was paid with regard to capital and the premium at redemption. So now we are paying the full amount. Why are we paying the amount now? Because we raised the loans. We raised funds through the bank loan, and we also raised the funds through the public offering, through the loan, and the total of the two became $1 million, because here we raised 720,000 and here we raised 300,000. So now there's money available in the bank, because if you say 300,000 plus 720,000, this will give us 1,020,000. So now it means we do have money available. The minute there's money available, therefore now a payment can take place. So now we are making a payment of the 1,020,000 that we owed to the preference shareholders. So now we are making a payment under 2.4.5. 2.4.5, we are making a payment. This will be 2.5.5. 2.5.5. I hope my numbering is right. Yes, 2.5.5. Let me also check other numberings. 2.5. Yes, my numberings are correct. Then now we record the entry now where we are making the payment. And to make the payment, obviously the bank will have to be credited. So now let us first credit our bank. And bank will be a total of 1,020,000. This is what we are paying. Then after we cancel the liability, because we raised a liability previously, and that liability was preference shareholders, 1,020,000. Here is the preference shareholder. So now this must be cancelled. Remember, the amount on the debit side, which is the amount of the capital, was already cancelled, because the minute this was debited, we were cancelling the equity capital which was on the credit side. This is an expense at the end of the year, get to be closed off to retained earnings. So this is not a problem. It will be closed off to retained earnings at the end of the accounting period. But we are not doing closing interest now. However, now the only amount that we need to cancel is the liability when we make the payment, because the debit entries are already covered. So there is nothing to worry about them. So now we have to cancel the liability, and the liability decrease on the debit side. Then hence we debit our preference shareholders. Preference shareholders, and our preference shareholders, it is 1,020,000 rands. So now we have recorded 2.5.5, the entry that was required of us to record. Then the next requirement, now we have done all the requirements. The next requirement now will be to compile the statement. To compile the statement, or to prepare the statement of changes in equity of Hope Limited for the year end 31st of December in the year 2015, in compliance with international financial reporting standards. And they say, please take note of the required identification matters as summarized in paragraph 6 of chapter 3 of the textbook. So now they just emphasize on making sure that we maintain the standard when it comes to compiling or preparing our statement of changes in equity. Then I will be doing that. Then from there I will be closing this question, because I will only go up to this far. Perhaps later on I can do the taxation part of this topic, where we deal with the issue of the tax. However, I will stop under 1.4 also because of time, and I don't want the video to be quite very long. So now we are doing the statement of changes in equity. And the statement of changes in equity is a very, very simple and easy statement. And that is requirement number 1.4 that we are busy with. Then it's 1.4. Remember, I only want to focus on specific topics, and I want to know that one video focus on one topic, another video focus on a specific topic. Therefore, now we are doing the statement of changes in equity. Statement of changes in equity. Statement of changes in equity in equity at 31st December, and this is 2015. Then we know that we start with ordinary capital. Please write ordinary stated capital. I'm just saving space here. Then we have preference capital. Then we have retained earnings. Then we have revaluation. Then after we get to our total column. I'm just writing this in short because of space purpose. Then now in drawing our statement, we know that we first have to record the opening balances. And after opening balances, we record everything that affects the statement of changes in equity. And I always advise that you must memorize the format and know revaluation, retained earnings. And this is on the 1st of January 2015. This is opening balance. Now you have to know that here we record opening balance, the issue of shares, the redemption, the buyback of shares. We write the dividends that were declared. We record the right issue. We record the capitalization issue. We record the redemption. We record the share issue cost. We record the premium. We record the revaluation surplus. We record the revaluation surplus. We record the profit for the year. So now all that get to be recorded in this one statement. Memorize everything that comes here so that you are able to copy and paste what belongs only in the statement. So now with regard to the ordinary capital, we had an opening balance, and that opening balance was 1,810,000. Preference with a capital that was in the trial balance of 1 million. Retained earnings, it was 875,000. I'll show you all these amounts. Revaluation is 30,000. I just have them in my mind. I still remember them. So now let us check these amounts that I'm just randomly recording here. The amounts are from the extract of the statement of the extract of the trial balance. So now the extract of the trial balance, there we see that we have ordinary stated capital 1,810,000. We have preference capital of 1 million. We have retained earnings of 875,000. We have revaluation surplus of 30,000. I just have them in my mind already. So now we have recorded all of that: 1,810,000, 1,875,000, and 30,000. So now let me just calculate the total of this. It will be 1,810,000 plus 1 million plus 875,000 plus 30,000, and this will give us 3,715,000 rands. 3,715,000 rands. Then after we record now all other entries, I normally prefer to start with the total comprehensive. I prefer to start with the total comprehensive. Total comprehensive income. Our total comprehensive income, it was 305,000, if I still remember. It was 305,000. This is for obvious. Total comprehensive is from the statement of comprehensive income. Our total comprehensive was 305,000, but 40,000 was for the revaluation surplus included in this amount. Then it increased, they said, was increased on property. It was 40,000. Included in this amount was an increase in the revaluation surplus of property of 40,000 rands. So now we have to record that. Then our 305,000, we have to say 305,000 minus 40,000, so that we separate the two. The rest will be recorded under retained earnings, 265,000. 40,000 will be recorded under revaluation surplus, and the total of 305,000 still gets to be recorded under the total 305,000. However, always split the revaluation surplus from the total comprehensive. However, the total is the full amount. Then after we go to the right issue. The right issue amounted to 900,000 rands. If I still remember, the right issue amounted to 900,000 rands. Remember here, we record the amounts, not the numbers. The right issue was 900,000 rands. There was the right issue of the shares, 900,000. It was ordinary shares that were issued as the right issue shares. Then after, there was an issue of ordinary shares. Ordinary shares issued. Ordinary shares that were issued to the public, they amounted to 720,000. There were ordinary shares that were issued, and they amounted to 780,000. And those shares were issued because there was not enough money to be raised. There was not enough money to be paid to the preference shareholder. And we have recorded that under 2.5.3, that was the issue of ordinary shares. Or ordinary shares issued because of the redemption or the financing of the redemption of preference shares. So now that is the one that we record again. Then after, now we have accounted, let me check if we have done it all. So now we have accounted for the right issue. This was the right issue. We have accounted for, we still have to account for the share issue cost. Let us record that, share issue cost, so that we don't forget. Share issue cost, and share issue cost is 10,000. Remember, this is the cost that we incur to issue the shares, and share issue cost will go straight under our total 10,000. So now we record that negative under the ordinary stated capital. Why? Because this is the cost of the issuing of the ordinary shares. It does not affect the preference shares because there was no cost to issue preference shares. Besides, during the current year, there were no preference shares that were issued during the year. Then now, after we have recorded the share issue cost, we go and check if there is another entry. 1.3, there was a buyback. We have to record buyback of ordinary shares. Buyback of ordinary shares under 1.3. Buyback of ordinary shares. Buyback of ordinary shares. Let me just use a different color. buyback of ordinary shares. Buyback of ordinary shares. The buyback of ordinary shares amounted to 181,000 rand of the capital that will be bought back. However, there was a premium, because always at the buyback there will be a premium, and at the buyback there was a premium of 169,000. Then now, if there's a premium, then we'll also have to take that into account. Then we add the two, I think it was 350, 181,000 plus 169,000, and this will give us 350,000. 350,000 rands will be the amount under the total column. Then after, now we have to check if was there any perhaps dividends that were declared. I think there were dividends declared. Ordinary there was no declaration, but the preference there was. However, let us check. We have recorded number 4 already, 720,000. We have done that. With regards to ordinary, the proposal was rejected. Here was the rejection of the proposal, so there was no ordinary dividends. And we have to first record now here the redemption. Or remember, there was preference dividend that were declared here. Yes, let us record the preference dividends, which is under 2.2. Preference dividends were declared and they were paid out of the available cash resources. And that was 40,000. Remember, 40,000, if you still remember that. We said that out of the million, we said a million, capital, preference, capital, times by percentage, because dividends, when it comes to preference dividends, they are calculated from the capital based on the percentage, or using a percentage based on the capital. And we said this will give us 80,000 rands, and the 80,000 rands is the preference dividends per annum. And we multiply that by 6/12, because the preference dividends were declared and paid in June. So now it's only for 6 months. Therefore, now we said it will be 40,000 rands preference dividends that we'll have to account for. Preference dividends. So now that's where the 40,000 comes from, and it must be recorded in the statement of changes in equity, and this will be recorded under retained earnings. Then it will be preference dividends. Preference dividends. Preference dividends. And our preference dividends is an amount of 40,000 rands negative, and 40,000 rands under total negative. There it will be 40,000 rands. Then now we have to check for the redemption. Now there was a redemption of preferences, which is, I think that's supposed to be the last one. The redemption of preferences is now under 2.3. That is where the redemption is, 2.3, just to clear my page so that we are not embedded with so many writings. So now there was a redemption in 2.3, and that redemption in 2.3 is the one that we are about to record now. Then the redemption of all the preferences is the full amount of the million and the premium of 20,000. Yes, there was a redemption 2.3 where the directors passed a resolution to redeem all of them, and we said all means the all 200,000 shares which were issued at the price of 5 rand, and we said this multiplied by 5 and it gave us 1 million. And that was the confirmation of the same 1 million that you see in the trial balance. Then there was a premium of 10 cents per share, and you said times by 200,000 because it is per share. How many shares are being redeemed? All of them. And all of them, it is 200,000. That is all the preference shares that have been issued so far. However, the one that were available was 500,000. we did not issue all of them. Take note of that. We did not issue all of these shares. We only issued 200,000 and redeemed all that was issued. You can never redeem something that you never issued. You only redeem what you have issued. So now in this case, we redeem all that was issued, not all that was authorized, only all that was issued. So now all the shares that were issued, which is 200,000, must be redeemed at a premium of 10 cents per share. And you say 200,000 times 10 cents will give us 20,000. So that's where the 20,000 comes from. So now we are recording this case the redemption. When it comes to the premium, guys, and the capital, please don't multiply by the number of months, because the premium is not for the year, it's per share. It's 10 cents per share, not 10 cents per annum. If it was 10 cents per annum, then we'll have to say times by 6/12. So now in this case, we don't divide by the number of months when it comes to the premium, even if the redemption takes place in the middle of the year. You only do that with regard to dividends. Why? Is because the 8% of the dividends due to the preference shareholder is for the full year. So now if the declaration of preference dividends is during the year, before the end of the year, we have to account for the number of months. This is very crucial and very important. So now we are recording the redemption, which is the total of 1 million and the total of 20,000, which is 1,020,000 in total. So now we have to record the redemption of the preference shares. And after this redemption, I think this is the last one. Then we say redemption of preference shares. Just a different color. We are recording now the redemption of preference shares. Redemption of preference shares. Redemption of preference shares. Please bear with my handwriting. All the preference capital was redeemed, the full 1 million, and the premium is 20,000, and the total will be 1,020,000 negative. Then now from here we can calculate the total at the bottom. I think all has been recorded. I'll just confirm if I did not miss anything along the way as I will be calculating. We have recorded 1 opening balance, 2 total comprehensive, 3, 4, 5, 6, 7. All the entries, I think we have covered them in this statement. So now let us just calculate our totals and check where maybe we could have done a mistake, if there could be a mistake. 1,810,000 plus 900,000 plus 720,000 minus 10,000, which is the share issue cost, minus 181,000. This gives us 3,239,000. 3,239,000. Then preference, we have nothing. Our retained earnings will be 875,000 plus 265,000 minus 169,000 minus 40,000 minus 20,000. Then this will give us 911,000, and this will be 70,000. Now let us check the totals. Plus 70,000 plus 3,239,000. This gives us 4, just a different color, 4,220,000. Let us scroll on the vertical side. 3,715,000 plus 305,000 plus 900,000 plus 720,000 minus 10,000 minus 250,000 minus 40,000. This, okay, minus 1,020,000 is 4,220,000. So our statement is balancing. Sorry students, I just want to make correction with regards to the calculation of the average issue price in this assignment. So now in that average issue price, we had to say total ordinary stated capital divided by the total ordinary shares. So now the only part that I want to adjust is this one, where we had to subtract our share issue cost, because the 900,000 was because of the shares that were issued at the right issue. Then the only thing that I forgot to do is to subtract 10,000, and that 10,000 was the share issue cost. Please go and check for that. Share issue cost was 10,000 rands. Then now it means we'll have to adjust our amounts. 900,000 minus 10,000 will give us 890,000, because the share issue cost was because of the shares that were issued. That means again we'll have to adjust our total ordinary share capital, which will become now 2,700,000. However, the number of shares does not change, and that means now our average price will change from 181 to 180 cents per share. Then our buyback price does not change, still 3 rand 50 cents. Then that means the average again share issue price will be 1 rand 80, and if you say 1 rand 80 now, I minus 3 rand 50, that will give us 1 rand 70 cents. It will be 1 rand 70 cents. Let us confirm that. We do that by saying 1 rand 80, 1.80 minus 3 rand 50. Then this gives us 1 rand 70 as the premium. That means our premium will go up by 1 rand, and our average share issue price, it will be 1 rand 80. So now I'm just making that adjustment, which come from the 10,000 of the share issue cost, because share issue costs get to be deducted on the ordinary stated capital. So that's why now it must be subtracted here. That's why we deduct this, because share issue cost is the cost that was incurred in order to issue the shares. Therefore, now once again, our premium at redemption will change from 169 to 170. It will be 170 times by 100. Then we multiply that by 100, and we will get 170,000 rands. We'll get 170,000 rands. Then after we say 1 rand 70 times by 100,000, that means it will give us 170,000 rands. Therefore now 170,000 rands will be our premium at buyback, 170,000 rands. So now this will be the new premium. Therefore now again I have to make an adjustment with that ordinary stated capital, which is 1 rand 80 cents times by 1 rand 100,000 shares. Then this will give us 180,000 shares, 180,000 capital that was bought back in terms of ordinary. I just want to make few adjustments only because of that, and I'm using the same table or the same answer that I've given to you. So now again our ordinary stated capital will change to 180,000, and our premium will change to 170,000. However, the total still remains the same. So I just want to make those few adjustments for you. Remember, the reason for this adjustment once again is because I just forgot to record the issue cost, the share issue cost of 10,000. This is the share issue cost. I want to emphasize that share issue cost is the only one that I forgot to record. However, all other calculations, they remain the same. They are still correct. So now because of that, everything had to be tweaked slightly. However, the major calculations are still correct. So now because of that, in the journal entry now, we have to make adjustments and say under our ordinary stated capital, it will be 180,000, as we have seen that. And under our premium at buyback, it will be 170,000. Then, however, now when we add the two, 170 plus 180,000, it still gives us the same 360,000. So now there is no adjustment with regards to that. Then this effect would have impacted the statement of changes in equity. So now let us go to the statement of changes in equity and we see which changes could have been done. Remember, the changes is only with regard to the buyback ordinary capital and the premium on the buyback. So now that means adjustment will be again made with regard to the shares or the capital. That means we have to make an adjustment from that 181,000 to 180,000. Then we have 180,000, and here we have 170,000. That is where the adjustment is taking place, 180,000 and 170,000. However, the total still remains the same. And now after all these adjustments have been done, then now we have to make an adjustment of the totals. And it means now under our total, it will be 3,240,000. Then this will be 240, not 39,000. Why? Because we deducted 1,000 here because it was 181. Then we drop it by 1,000 to 180,000. And again, under the column of the retained earnings at the bottom, we have to change that 911,000 to 910,000. It will be 910,000. So now it's no longer 111,000, but 110,000. Let me just remove one. Then it will be 110,000. All other amounts remain the same. The total still does not change. It is still correct. So now it's only those few adjustments that I wanted to change. I don't want to change the whole video because there's very important content that I had to make adjustments that I have explained. However, now if you were being marked, you still get a mark for this and get a mark for this, even if the journal entry would have been wrong because you used the same amount and you had transferred that here. So now I've made that adjustment. And with also regard to the rest, everything remains the same. We still have 4,220,000. And I also want to make this correction with regard once again to the solution of this assignment. In the solution of this assignment, they recorded 300,000. And please make correction for that because it is not 300,000, it is 350,000. That is a mistake that is in the solution. And here they recorded 960,000 in the solution, and that is also wrong. And the amount they recorded here is also wrong. So now go and see those adjustments. Then you make sure that you effect them whenever you are practicing. So now with that being said, I have covered all that I wanted to cover, and I have done this adjustment. So now if you have any questions, don't hesitate to just hit me with the email, then I will respond to your emails. Thank you guys for that patience for the adjustment. With that guys being said, I will say thank you and God bless. I hope you have understood something in this question. I try to critically analyze and make you to be open-minded, and I hope you'll understand something out of this. And when I was doing this, please be mindful of the fact that I did not have a solution for this, but I critically analyze and I think everything that I've done is 100% correct. So now thank you. I'll just say God be with you and enjoy this task. Thank you.